Most people believe that having millions in capital is the only way to win at investing. However, legendary investor Charlie Munger argued that being a small investor is actually your greatest secret weapon. The giants of Wall Street are trapped by their own success, limited by the sheer weight of their capital. When you manage smaller sums, the entire landscape of the global market remains open for your picking. You can move faster, hide better, and find hidden gems that a billion-dollar fund would never notice. Today, we're breaking down the 6 specific reasons why your size is your ultimate edge for wealth. Understanding these mental models will change the way you look at your portfolio and your future. Large institutional funds are structurally forced to target only the most massive, liquid businesses on the exchange. If a fund manages $10 billion, buying a small-cap stock simply doesn't move the needle for them. As a small investor, you have the flexibility to enter niche, regional, or obscure opportunities with ease. This is why Charlie Munger always warns that size is the ultimate enemy of high-performance returns. You can invest $10,000 or even $2 million in places where the big sharks cannot follow. While they fight over the same 10 massive tech stocks, you are exploring the untapped 99%. Munger noted that his highest percentage returns occurred when he was working with much smaller amounts of capital. This structural freedom allows you to capitalize on mispriced assets that simply aren't large enough for Wall Street. Remember, the smaller the pool you play in, the less competition you face from the world's smartest minds. Inspired by Benjamin Graham, Munger frequently discussed the cigar butt style of value investing for small players. This strategy involves finding beaten-down, unglamorous companies that are trading far below their actual liquidation value. It isn't about finding an exciting growth story. It's about the cold, hard mathematical certainty of the balance sheet. You are essentially buying assets for less than the cash or physical property the business already holds. For a small investor, these free puffs on a discarded cigar can lead to massive, low-risk gains. Larger funds avoid these because the total market cap is too small for their massive overhead and requirements. By focusing on value over hype, you secure your downside while waiting for the market to realize its mistake. This rational approach to unloved assets is a cornerstone of the Munger philosophy for building early wealth. Most financial advisors will push you toward a traditional 60-40 stock and bond portfolio for safety, but Munger often critiqued this, suggesting it's designed to manage the advisor's career risk, not your growth. For those with long-term horizons, equities have historically outperformed bonds by a staggering margin over many decades. Being a small investor allows you to be more aggressive with your allocation if you have the stomach for it. Many people wait for a market crash to enter, but they often lack the discipline to actually buy. Munger noted that the big money is not in the buying and the selling, but in the waiting. Your edge is the ability to ignore the standard mediocre advice and hold through the inevitable market volatility. Passive bonds may feel safe, but for a wealth builder, they often act as an anchor on your compounding. Even the greatest investors make mistakes, as seen in Warren Buffett's unsuccessful bet on silver. The lesson here is that being right about fundamentals doesn't matter if your timing is completely wrong. As a small investor, you must realize there are no permanent market conspiracies holding you back. Supply and demand are the only forces that ultimately dictate the reality of any asset's price. Betting against these fundamental economic forces is speculation, not the disciplined investing Munger practiced and preached. You have the luxury of waiting for the perfect pitch without answering to impatient quarterly shareholders. Use your small size to stay nimble and avoid the ego-driven traps that catch the major players. Humility and a focus on reality are the only ways to survive the market's unpredictable cycles. Disruption is predictable in its direction, but it is almost always unpredictable in its timing and outcome. Most retail investors lose their shirts by chasing hyped trends right as they reach the absolute top. According to Munger's mental models, it is better to be safe and rational than to be trendy. The better strategy is to ignore the loud narrative and stick to businesses that generate real cash. If you do choose to play in disruption, you must be incredibly early, patient, and mathematically rigorous. The small investor often wins by avoiding the hot sectors entirely and buying what is currently boring. Chasing the next big thing usually leads to a permanent loss of capital that ruins your compounding. Patience is the ultimate filter that separates the wealthy from those who simply trade for excitement. Success in this game comes from knowing your constraints and ignoring the daily noise of the media. Charlie Munger famously said, "It's not that we're so smart, it's that we stay sane." Acceptance of your own limitations and a dose of humility are strict requirements for long-term survival. Your edge as a small investor isn't a faster computer. It is a more disciplined and rational mind. Let the compounding do the heavy lifting while you focus on staying within your circle of competence. Don't try to be a genius. Just try to avoid being stupid consistently for 20 years or more. The market will try to bait you into emotional decisions, but you must remain an island of rationality. This is how the small investor transforms into a wealthy one rational decision at a time. Being small isn't a disadvantage. It's the greatest head start you could ever ask for in the markets. If you apply Munger's wisdom, your capital will eventually grow to the point where you face new challenges. But until then, embrace your edge, stay patient, and let the power of compounding change your life.